Hey friends, hello Lietz here. Today I want to help you guys to calculate what's called your debt to income ratio. If you're looking to buy a home and you're looking to get a mortgage loan of any kind, or if you're looking to refinance or anything like that, in regards to mortgage, lenders care a lot about your debt to income ratio because it allows them to assess risk. Now I'm going to show you in roughly 5 minutes how to calculate your debt to income ratio. There's two numbers we're going to be looking at. But before I get into this, let me just mention really quickly for those who may not know or those who are not familiar with this, what is a debt to income ratio? In simple terms, a debt to income ratio is the difference, if you will, or the ratio between your income, how much you bring in monthly, or perhaps you or whoever's going to be on the potential loan, and your debt that you pay out per month. Now, for mortgage sake, there's two different types of these that lenders care about. There's what we call a front-end debt to income ratio over here, and there's a back-end debt to income ratio. What are those two? The front end is a little bit easier to think about. The front end is the ratio between your income and your housing payment. Now, for mortgage purposes, we'll look at this. We call this your PITIA. That's your principal, your interest, your tax, your insurance, and your potential association dues. For those who don't know, maybe you're a first-time home buyer, your PITIA, that's your mortgage payment. Because your mortgage payment, very often the case, will include all of those things. So your front-end debt to income ratio, which is represented as a percentage, okay, that is only taking into consideration your housing payment and your income. So how much of your income is your housing payment taking up, okay? I want you guys to grab your calculator really quick. Maybe if you have your phone right there or something, grab a calculator because you want to use this. Again, I'm going to show you this very quickly. This is important because if you're going to be eventually looking to get a mortgage loan, you want to know what your debt to income ratio is because there are lots of different types of loans and those types of loans have terms and conditions. And every single one of those loans, well, minus maybe one type, which is investor loans, but pretty much almost every single type of loan out there is going to have limitations and terms and conditions on your debt to income ratio. Now, the second type is called the back end ratio, your back end DTI. Your back end ratio takes into consideration your income divided by not just your housing payment, but any of your other monthly obligations that, for example, show up on your credit report. So that would be your housing payment, your PITIA, and lots of other payments. Let's say things like credit cards, things like student loans, things like unsecured loans, so forth and so on. Okay, so I'm going to share my screen with you guys. Let's jump right into it. I want to show you just a couple of examples on how you can do this yourself. Also, in the description box below, you're going to see a link there to a free tool that I've created. It's an Excel spreadsheet, or you can use Google Sheets if you want. This will help you to track your monthly bills, okay? And then using that, you can calculate your debt to income ratio for your front end and your back end, okay? And then in a second here, I'm going to explain to you some of these different programs and where the ratios sit in terms of the guidelines, okay? So here we go. I'm going to share my screen with you guys right now. I have my pen here. Here we go. Okay, so hopefully you guys can see my screen here. Okay, so the front end is what we're going to do first. So let's say hypothetically, okay, that your income, so I'm going to do I here, okay, and forgive my bad handwriting. I'm a lefty. So let's say your income is $4,000 a month, okay, just as a hypothetical. So here's 4,000, okay? Now, let's say that your debt payments, okay, and it doesn't necessarily have to be debts, but it could be your liabilities and so forth. But for this one, your debt payment, if you will, your housing payment, because we're looking at your front end right now, your debt payment, right, is, let's say it's $2,000. Okay. So for those of you who already been through this kind of stuff, you already know what the answer is, right? What we're going to do here in order to calculate your ratio is we're going to take your debt and we're going to divide it by this income. So now what are we going to do? We're going to take this 2,000, okay, divided by 4,000. And if you use your calculator, of course, you know what the answer is, right? Okay, 0.5. Now, in terms of a percentage, right, 0.5 is the same thing as 50%. So in this scenario, okay, your debt to income ratio is 50%, okay? In mortgage terms, that's actually pretty high. Now, it doesn't necessarily stop you from getting a loan, but in generally speaking, you want your debt to income ratio to be lower than that. If you're looking at the loan and so forth, and you're concerned about these things, give me a call and I'll walk you through it, and I'll talk about these different loan types in more detail. But for the purpose of this video, that's how you calculate your front end debt to income ratio, which is again just your housing, okay, and your income. So now let me wipe this slate clean. Actually, I can do, let's see here, if I just add another one here. I'm going to go here. Let's get rid of this one here. Okay. Let's say now you have the same income. Let's say your income is, let's go back there. Your income is $4,000 a month. Okay. Now let's put some debt payments in here, because now we're going to calculate your back end DTI. Okay. This is going to include your housing payment and many other payments that potentially show up on your credit report. Okay. So now we're going to put your debts here. Let's say, for example, okay, let's go down here. Let's say that your housing payment, right? Actually, you know what I'll do here, just for accuracy purposes here, I'm going to delete this and I'm going to put this as PITIA, right? This is your principal, interest, tax, insurance, and potential association dues. So let's put that where, let's say it's a little bit lower. Let's put this down at $1,600. So let's say you're going to potentially have a mortgage payment of $1,600. This is sort of a real example as well, because I have a client of mine just a couple of months ago. He was paying approximately I think it was $2,200 a month. And we were able to, myself and my team, we were able to get him a payment that was right around here. I think it was like $1,679. But for this example, let's make it simple, $1,600. Okay. So let's say your mortgage payment, PITIA, is $1,600. Let's say for the purpose of this example, and I'm going to put a line here because we're going to separate these. We're going to look for this number, your debt number, in a second, because we're going to add all these up. So you've got your mortgage payment here, potential mortgage payment. Let's say you have a credit card. So I'll put CC here. Let's say your credit card, or all of your credit cards combined, is, let's say, roughly $300. And let's say that you have student loans. So we'll put ST right here. Let's say your student loans are $100. Okay. So now you want to take all these debt payments here and add them up. Well, $1,600 plus $300 is $1,900. $100 plus $1,900 is $2,000. So now guess where we are again, right? Here we go. Just trying to make a simple example. Now your debt is $2,000. Now, of course, if you remember from our previous example, we came up with the same number. In order for us to calculate your back end, and I'm going to write this again here. This is your back end DTI. Okay. We're going to take this 2,000. Okay. And we're going to divide this by 4,000. Okay. And of course, again, we get 0.5, which is equivalent to 50%. This is a 50% debt to income ratio. Now, a back-end ratio of 50% is, again, pretty high. Many lenders want your debt to income ratio to be lower than 50%. However, that doesn't necessarily stop you from getting a loan. There are loans, for example, VA loans, veterans loans, or FHA loans, Federal Housing Administration loans. Many of those are for first-time home buyers, where you can go up to 56%. So let's put this number here. Let's go here. Actually, I like the color green for this one. You can go up to 56% on a back-end DTI for FHA. Okay. And sometimes you can go on certain loans, you can go up to 60% on something called a manual underwrite. Okay. So just because you have a debt to income ratio higher than 50 or 60% or something, that doesn't necessarily mean you should stop looking or that you should stop talking to a lender or that you don't qualify. It just means you want to have a conversation. We want to take a look at your very specific situation to figure out what is the next step for you in your journey toward home ownership or your journey to getting another property. Let's say you're buying an investment property, or if you're going to, let's say, for example, you're going to do a cash out refinance or something on your house, or maybe even a home equity line of credit. Your debt to income ratio is super important to lenders. Okay. So again, just to recap, you've got your front end debt to income ratio and you have your back end debt to income ratio. I'm Lietz again with Logical Loan, and we'll see you guys in the next one.